For a quick reaction to the first rate hike announced in over 4 years. Ms. Goyal, it's great to have you on the show. Thanks very much. Your prima facie take on this rate hike, as I'm sure it may have surprised the majority on the street.
Yeah, I think that since they have gone in for a rate hike, sticking to the inflation targeting perspective, it is good that they have maintained a neutral liquidity stance, because if they had tightened, that would have meant the market would have priced in more of a series of hikes. And also it gives some leeway to maintain liquidity, because other rates have been rising recently because liquidity has been on the tighter side. So this should sort of help soften somewhat the loan rates despite a rise in the repo rate. But the other point is that I do not share their optimism on growth prospects, because if you look carefully at the growth numbers, they've been driven by government spending and consumption is still weak. And if investment has been rising, that is sensitive to interest rates, and in general demand is sensitive to interest rates. And moreover, because food prices have remained soft and investment is rising, that suggests improvement of the supply side. So you need not worry about the output gap closing. And even for oil, we see some softening recently. So it is possible that the inflation projections will turn out to be lower than their current situation.
Do you say that it will be premature to assume that with this rate hike the RBI is done, or do you think we could expect more by way of rate hikes to come in the next few policy announcements as well?
No, I think that we cannot presume any such thing, because they have also said that there is a lot of uncertainty even regarding inflation. It will be data dependent. We could see some softening in inflation, then we would not need more rate hikes, and they would not undertake more rate hikes. That is what I said. Maintaining a neutral stance means they are communicating that there is no future rate hikes necessary. They could go in either direction, either hike or hold or cut even, depending upon the data and the inflation and growth realizations going forward.
Understanding and experience, how should one look at this dichotomy? Because typically, in the past, when we've seen a rate hike announcement, the stance has been hawkish. Now, the RBI is saying that there's no conflict between the rate hike and the MPC's neutral stance. Like you pointed out, all options are open for the future. They're saying economic revival is now on sound footing, and they're monitoring liquidity conditions which seem comfortable. Inflation over the next 6 months can be a bit of a risk, but the risks are still balanced out for FY19, and they're keeping the growth projection stable at 7.4%. Could you join the dots and just help our viewers understand that what does this really mean for the road ahead?
So I think it means exactly that inflation is as likely to surprise on the downside as on the upside. Also, base effects usually working out, so inflation could actually fall. And in that case, compared to their forecast, in that case, they have room to cut if necessary in the next policy. But it depends on oil prices also. We've seen some softening recently. If that softening persists, they have room to move in either direction. And an interesting take on this is that in the pre-poll survey, the majority of economists supported a hold, and the majority of market participants wanted a rise and have actually factored in a 50 basis point rise. So I think this market position was perhaps based on a perception that the minutes were very hawkish for the last policy. So I think markets should realize now that the stance is neutral, it is somewhat dovish, and it is not necessary to hike in a series of rate hikes, because there's possibility also of a cut given a neutral monetary stance. And if there can be action to make liquidity more comfortable, other market rates that have been hardening recently could also soften.
Dr. Goyal, Dr. Ashima Goyal, this is Supriya Srinath. I'm joining from the RBI headquarters, and having heard the governor's press conference, you're right that he's perhaps keeping the stance neutral because they're giving themselves the elbow room to move either which way. One of the questions that was put forward to the governor and to Deputy Governor Viral Acharya was, is this based on the pass-through of the oil prices to the consumer? And they said, yes, this assumption is based on that, which is why inflation numbers have also been revised upwards for this financial year, both for the first and the second half. I'm curious to understand from you the new formula that the government seems to be working on. It's a long-term formula that the government seems to be working on. If pass-through is not complete, is the RBI giving itself an elbow room to pause or to perhaps even lower rates? Because this is largely based on crude oil prices. 66 to 74 is how crude has moved from last policy to now.
Right. There is room to cut even if their projections do not materialize. There is equal chance on the downside for inflation risk as on the upside. And in fact, given base effects and the softening we have currently seen in crude, my own view is that the downside is actually more likely to materialize.
Fair point indeed. A quick question, however, on the efficacy of rate defense, and the governor said it's all based on just the CPI projections, whereas the articles that he's written and the noise that is being made has a lot to do with what the developed markets, the Fed is doing as far as shrinking of balance sheet is concerned. Do you believe he had that in mind as far as this policy was concerned? And what is also interesting about this policy is that this is unanimous. There isn't a fractured verdict on this.
Right. I think they're taking their inflation targeting responsibilities more seriously. And given their projected inflation, there was a unanimity on the necessity of a rate hike. But I think that reacting too much to external developments is not necessary, because we have had a very sequenced capital account convertibility, and there are limits on debt flows. And a lot of the inflows continue to be sensitive to growth, and therefore maintaining growth and nurturing the turnaround in growth is also important. Moreover, the governor's statement on the balance sheet, the U.S. government balance sheet, you can apply the same argument here. Maybe we need to think it's more in the RBI's control what they do to the Reserve Bank's balance sheet. Maybe they can think about creating more liquidity here and therefore reducing the tightness we've seen in the market and the rise in G-Sec rates and other market rates.
Okay, thank you very much, Dr. Ashima Goyal, for joining us.